had to pay, it was actually Bank of New York Mellon, this huge amount of money. Let's see, it looks like $10 million. It says $10 million a year, or it can buy out of it for $29 million, which is the equivalent of 3 years of payments. But that's a huge amount of money that we, the city of Los Angeles, owes to a bank in New York because the head of the Federal Reserve accommodated the banks in New York basically at our expense. So it seems to me that in that circumstance, there should be some way to get out of that deal. It's not a fair supply and demand sort of thing where you're saying, well, I mean, it is all just gambling. It's all just betting, and you're betting.
It's a really good question. Great question, and I think it's one that people ask all the time because it's a scenario that does happen. Let's say 50% of the time, when things go wrong. When things go right, nobody ever asks the question you're asking. It's only when things go wrong. And so I don't know the specific example of what you're describing, but I can guess that what happened is that LA, so a municipality, has borrowed money, in the form of a bond. Maybe the interest rate on that bond might have been floating, and they decided that they didn't want a floating interest rate. And so to explain what that means, a floating interest rate is one that changes as interest rates move up and down. So it's not a fixed interest rate that they pay. They don't pay 5% every year. They pay 1% this year because interest rates are low, but maybe 4 years ago when they first took out the bond, they were paying 5% because interest rates were higher. And so when they first took out the bond, they would have said, okay, we're going to borrow this money, floating, because that's the easiest way for us to borrow money. But what we'd like to do is make sure that in no case do we ever pay more than 6% interest. So the risk we have in borrowing money floating is that if the coupon that we have to pay is a function of current interest rates, and if current interest rates go up, we're in trouble. So they go to a bank and they say, can you swap my floating payments for fixed payments? And the bank says, sure. I will pay you all the floating amounts, and you will pay me a fixed amount. And as a result, guaranteed, that's the fixed amount you will pay. The floating amount that I pay you use to pay the coupon on your bond. And in exchange for that, you pay me a fixed amount. So I, the bank, I will take any risk on the floating. So if the floating amount goes up, I'll pay it. If the floating amount goes down, it benefits me, but not worry about that. You're concerned, you're concerned about rates going up, so I'm going to protect you. And so what would have been agreed is what's called a very simple fixed floating interest rate swap. LA owes a bank, in this case, New York, Mellon, the bank, let's say, 5 or 6% fixed against bank paying them a floating amount, so that floating amount LA can pay out as a coupon or as interest on the bond, on the money they've borrowed. Now, when interest rates go up, when I said 50-50, it's a 50-50 thing. Interest rates can go up or they can go down. When interest rates go up, LA is protected. LA is happy, and they're not going to grumble about the fact that they're receiving floating payments that are much higher than the fixed payments that they have to make. Whereas when interest rates go down, it's not happy. All of a sudden, LA says, oh, well, hang on. We could have just been paying these really low floating payments. Instead, we have to pay these high fixed payments. And what LA did was they hedged themselves.
They what?
Hedged themselves.
Okay.
Because they could have, interest rates could have gone up, and LA could be paying much bigger payments on their coupon, but instead, and in that case, LA would have only had, say, the fixed for 5 or 6% fixed coupon that they had to pay. But in this case, though LA is hedged, they still only have to pay that fixed 5 or 6%. It's far higher than they would have had to pay had they just not hedged themselves in the first place. So, to some extent, LA wasn't necessarily making a bet. They were simply saying, look, we don't know if rates are going up or down, but we do know that we can't pay more than 6%. So if interest rates go really high, we're in trouble. So let's just fix it so that we never have to pay more than 6%. That would have been their thinking. And this is a very typical hedge product called an interest rate swap that is used by corporates, by municipalities all the time. And when it goes well, everybody's happy. And when it goes badly, then everybody thinks everybody's upset and blame the bank. Unfortunately, in many cases, the entity that took out the interest rate swap was trying to do the right thing. They were just trying to fix the amount they had to pay so that they didn't get caught by higher interest rate payments. And they did, nobody knows. Are interest rates going up? Are they going down? Nobody knows what that is. So the treasurer of LA, the municipality, had to make a decision about what was the best thing for him to do. And at the time, he probably, decided that the right thing to do was just to fix the coupon so that he, wasn't struggling to balance the budget if interest rates went up.
What do you say to that, Ellen?
Well, that does make more sense when you look at it that way. I suppose there's no getting out of it.
No, there's no getting out of it. And the truth is that the flip side of the coin, that he could have just decided to borrow money with a fixed coupon in the first place.
Mm-hmm.
So at the time, he could have said, okay, I'm not going to borrow money with a floating coupon. I'm just going to borrow money with a fixed coupon. And that fixed coupon would have been, let's say, 5 or 6%, exactly what he's paying on the swap. And had he done that, nobody would have complained. It's a bond. Everybody's happy about, they understand bonds. But as soon as you say, oh, well, he has to pay that money because it's a swap, people think, oh, the bank's trying to take advantage of him. And look, I'm not going to sit here and tell you that banks don't try and take advantage of people or institutions, at some point, because that certainly does happen. I think that, it's human nature. But in many, many cases, this is a very simple, very straightforward product that many treasurers understand because it's relatively straightforward. It's a product that they use a lot, and it's something that they do to protect themselves.
So it could be too
unlikely that it was missold or that someone was taking advantage. It's more likely that the treasurer of LA was just trying to do the right thing at the time.
How about if treasurers of states, like many states in the United States, are doing the same thing? Because many states in the United States want to go sovereign, and many states in the United States, Ellen, correct me if I'm wrong, are in financial turmoil. I'm wondering how many treasurers have been using this particular option financially, and if any of this particular percentage exchange swap is part of the problem.
Well, I would be surprised if many states haven't used interest rate swaps, but I have no idea how it contributes to the fact that states have budget strengths or budget concerns. I suspect that the majority of the budget concerns are a function of a smaller amount of taxes coming in to pay what is an ever-increasing amount that needs to be paid to take care of, the various responsibilities.
Mm-hmm.
the state.
I would think the problem with credit default swaps in general, or derivatives in general, is that they're so complicated. And I read this somewhere that you, like, say somewhere in the South or what, you know, you have people running for school boards or whatever that are just trying to help out their kids. They have absolutely no